I'm Glynn Tonsor. I'm the token livestock economist for the day. I lose more hair every time I see you guys. It's always a standing joke, but it's true. I'm balding quickly, maybe because I've been at K-State too long. But more serious, I enjoy being back here. I enjoy events like this where I get to talk to you guys about things I know you care about. I wish I was here at a time when there was a little more bullish things to share from the cattle market. But from those of you that have seen me before, whether it's here or elsewhere, I'm not going to hide from it, so I'm going to tell you what I think, and it's more bearish than it is bullish. But I do think the market is overdoing what we're going to call a correction at the moment, so I'm going to give you all the context for that I can in this talk. So you have these slides. I'll remind you, I'm more interested in getting the story across to you than I am precision in the numbers. You can take as many notes as you want. You got these handouts later, but I really want to get the core message across to you. I want to start as I always do. I always joke saying I think I can explain almost everything with supply and demand. As good trained economists, we think we can do that. And I certainly think you, in order to understand what's going on in the cattle markets, you have to think about both supply and demand factors. I'll remind you to go back to 2014, so a real short history lesson for a moment. The fourth quarter of 2014, pretty much regardless of what weight class we're talking about, was the high in the markets. The reason we had the high, and this is a real bold statement, I think we're going to increasingly look at that as the high, right? The pullback in September makes it really safe to say that, but is we had strong demand and very tight supplies throughout 2014. Most people didn't appreciate the strong demand piece of that story. It's very easy to recognize we had low calf crop numbers. It's harder to understand what beef demand is, but I'm here to tell you both were pulling in the right direction. All right, so before I even get to all the red ink that's going on in a minute in the feedlots, which is what I'm most concerned about, the main reason that September's been so harsh is growing concerns by market participants about demand. Okay, so I'll belabor that a lot, but that's the part that's changed most since you've seen me last. We haven't tripled the herd or anything like that since you last saw me. We've started to expand the herd, and I'm going to tell you I think we're going to keep doing it. But that part hasn't changed nearly as much as the concerns on the demand front. I think those concerns are a little bit overdone, and I'm going to try to show that for you guys. But it's important to appreciate that's the main reason the market's pulled back as much as it has here in September. So I like to take us from CowCalf all the way to the consumer. I think just biologically that's the way the industry works. That's the way a lot of people think about it. So that's kind of the order of our talk here. So when you talk cow-calf, let's start with prices for calves. This is a Southern Plains price chart LMIC puts out. I won't belabor this in all of them, but I will tell you these are all structured very similarly. Is the current year is the solid blue line, so it's year-to-date prices. The prior year is the dotted, dark blue line, and the prior 5-year average is red. Several of the charts I'm going to show you have that same setup. Remember my comment, it's very safe to say now, but for some time analysts have been saying fourth quarter of 14 was the peak in this market. Pretty clear that was the case. We hit the turning point, if you like, particularly on demand signals since then. Going forward for the rest of the year, this was dated the 21st. If it's updated, we'll be even lower. And if you look out to the futures market, we'll continue to be lower yet. Maybe flat from where we're at, probably a little lower yet, as we continue to have more calves come to market. Okay. Context is also important, though, because if you draw a line right here, that looks way, way bad compared to this line of 2014. But if we go back in time 2 years ago, if I was drawing my line right here, you'd still have a lot of excitement in cow-calf country, right? We are still looking at the second best year ever in 2015, even with the September pullback. But it's a lot worse than 2014. So it's all about how you look at that, right? There's people kicking themselves for not selling the whole calf crop 6 weeks ago, because that's human nature, right, at this point. But it's still going to be a very good year for anybody that's got average cost production. Okay? And the reason it's going to be a good year is not only do we still have, by historic standards, good cow-calf sales prices for output, cost structure is pretty good. So range of pasture conditions are pretty good. Save California, Nevada. I don't want to pretend like they don't exist. But for cow-calf return purposes, that's not key to where we have mama cows in the country. So good pasture conditions, lower operating costs coupled with lower grain costs that are part of the concerns from other talks. Okay? Leads to this slide, which is positive margins. So this goes back to 1987. It's returns over cash cost LMIC puts out. I'll call your attention to the bottom here. It's dated September 24th. Over here to the far right, we have historical numbers, and we have a value that's projected for 2015 and projected for 2016. And we have a purple line here that I've added that's at roughly $150 per cow. I always add that to give you some context on just how far out there 2014 was. Prior to 2014, 04, 05, and almost 2013 were 3 years that came close to $150 returns per cow. And we used to look at those as the good years. This 04, 05 period is the last time we actually pulled the trigger on expanding the herd. We're doing it again because we have abnormally high returns. 2014, we broke $500 return over cash cost for a typical Southern Plains average cost cow-calf operator. It's because you had those record output prices and improving cost. 2015, that number is down, right? You can read the number up here. It's $398, so it's still $400. So it's still 2.5 times what I used to call a good year. But it's off over $100 from 14. So it's all about how you look at it, right? I don't want to pretend the $100 don't matter, because it does matter. But it's still a really good year by historic standards. And the reason I'm beating that in your head is I'm getting more and more questions about, is this pullback that's going on in September going to stop the herd expansion? And I say no, no, no. As long as you have a positive margin, and I'd say a very strong positive margin, we're going to bid away that margin by expanding the herd. So as long as Mother Nature keeps raining in key cow-calf areas, I think we're going to keep expanding the herd. I think it would be a notable pullback in margins before we stop that, and we'll probably stop it too late in the sense of margins, okay? Because that's normally how that works. Looking out to 2016, we're still projecting a very good return, but notably lower than 2014. I included this text box here just to give you some context on how the pullback during September has hit these margins. And just in September, we've taken about $70 off that. Right? So it's legit. I'm not going to pretend it doesn't exist. But my real message is those numbers right there are still plenty large enough. We're going to keep adding mama cows to the herd. Okay? For context, I included this chart as of the 4th. That's where those numbers are coming from. So I'm saying we're expanding the herd to give you context of why I'm so confident in that. This is a chart that goes back to 1985. It's heifer retention as a percent of the breeding herd. So when this number is going up, it's a signal we're expanding the herd more aggressively. And you can see the last time we had notable increases year over year, again, was 0405, my comment about last time we were expanding the herd. Going back all the way before this starts in 1985. I have the raw data for it. It goes back all the way to 1974. 2 of the 3 largest years in terms of heifer retention as a percent of the female herd are right now. Okay? So what I'm trying to convince you of is we've never tried harder to expand the herd. Now, we're doing it from a small female base, right? So that's important because we're not going to double the size in 2 years. But we've never tried harder to add. The economic signals, i.e. $500 returns, are strong anywhere you can add, right? So for some people, that's just rebuilding. For some, it's expanding. But in aggregate, we're growing the herd. We're doing it, and I think we got 3 more years, maybe 5 more years of that ahead of us if it rains. Okay? 3 to 5 years comes from this chart, coupled with those very positive margins. Most of you have heard talks about cattle cycles. I could give full talks on this if you want. Feel free to ask me questions. But typically, they run 8 to 12 years. That's kind of the period from when we start to expand from when we go through the whole contraction phase. So they peak out, 4 to 6, 4 to 7 years into the cycle, depending upon what cycle we're looking at. The current one is this blue line right here. And my main point is we're on the very front end of an expansion phase. So again, if it keeps raining, because Mother Nature can trump all this stuff, I think we're going to continue to expand the herd for at least 3, and I'm going to say maybe even 5 years. Now, we may only have positive returns for 3 or 4 years, but I think we'll keep expanding for at least 1, maybe 2 years past that. Okay? Any questions real quick on the cow-calf side? You can ask me later if you want, but if there are clarification ones, feel free to go as we move along. It's my number 1 job to move around and keep you guys awake, so I only see 3 falling asleep now. If I get 3 more asleep in the next 5 minutes, I'll break serve and do something different. All right, so stocker backgrounder. Most of you know the Flint Hills is a big part, right, of this broader industry segment. And the fact that we put animals out on grass, we do wheat pasture, we do a host of things in the broader backgrounder stocker arena. What I want to do here is just call your attention to, if you don't remember from last year, is we have a resource that's very helpful to give you value of gain projections. So for this is a margin business, right? You compare the value of gain of adding weight versus the cost of gain of adding weight, figure out what the expected returns are. That cost of gain part of that varies all across the board. I can't help producers a lot with that in terms of just general advice. The value of gain part of that's just feeder cattle market dynamics, okay? And price weight slides. That's what's underneath all that. This is just one situation as of the 28th to buy a 575-pound steer in the middle of October with the plans to get it to 800 pounds by the 1st of February. I'm making this up as something typical. You can change the dates and weights to match the producer you're working with. At the time when I did this Monday, the value of gain for that was expected to be $100 per hundredweight. So if your cost of gain was $80, then that corresponds to about $50 expected return per steer in that exercise. Okay? My main thing is I want you to recognize this resource is here, and literally all you got to do is pick the market. In this case, I'm using Salina. If you're from closer to the borders, you can go use a Nebraska market or something else. You plug in the weights and the dates, and it spits out basically a futures market implied basis forecasted price, right, for the buy and the sell part, and it backs out this value gain number. Make sense? Okay? The other thing I want to highlight for this segment, as well as a cow-calf operator that's maybe concerned about what's going on right now in September, is we have this resource called Feeder Cattle Risk Management Tool that's an Excel-based decision aid to help you understand how alternative price risk management strategies compare. I'm not going to belabor it. I trust you guys are smart enough to know how to use it. If you got questions, ask me, but I'll chase forward to this slide right here. This is one of the things that comes out of that decision tool. And what it is on the vertical side, it's expected net selling price per hundredweight, because we don't know what the ending price is going to be, right, for something in the future. And down here on the horizontally, we have the ending futures price. So these are all uncertain things, right? But at this point in time, if you have a cash strategy, i.e. I do nothing, I just take what the market gives me, then you have this green line that's on a 45-degree angle, and if the market continues to fall, i.e. futures go from 170 to 60 to 50 to 40, then you're going to get less of that in terms of your net selling price, right? If we've already hit the bottom and from here on up the market goes up, let's just say we had 30 bucks to make it simple, then you're going to get rewarded for doing nothing because you're going to get that full rally on the green line, right? That's the simple example. In cattle country, that's what most people do, is they don't hedge, right? So that green line matches what they experience. The red line is a futures hedge, right? So if you go short, in this context, maybe a March contract because you have a February sale, then you basically establish this flat expected price because all you're exposed to then is basis risk, which basis can change. But your best guess is, regardless of how that March contract changes, my net selling price is locked in at that 168 and change number. That's kind of the two extremes to think through. The ones that have kinks are a little more complicated for people to understand, but those are the ones I always get questions about. The LRP, which is the blue line right here, that's a USDA product that works like a put option. And then you have the, I'm going to call it fuchsia. I don't know if that's right, but it's close to purple, but it's not purple. Put option that's right here like it. And they both have kinks. They both have kinks because you don't have to exercise them, right? You're purchasing the right to establish a floor. If the market goes up, you're going to benefit in that more than you did with the futures hedge. So those lines with kinks, the blue and the fuchsia one, are above the red one line over here, right? But they're notably lower than the futures hedge over here, right? So there's trade-offs there. The other trade-off you guys, if you haven't worked with a producer, you need to appreciate is the margin call impacts, right, of having a futures hedge. So if the market keeps going the way you want it to, right, so the hedge works, you've got huge margin calls to finance, those cash flow challenges, unlike a put option where you know up front exactly what it cost you, right? There's certainty on the cash flow impact. So you got those trade-offs, right, and that's why there's different strategies. My main goal here is to call your attention to the resource so you can plug in your own numbers, work with a producer, figure out if it's worth it or not for them to do this. Okay? Any questions on that? I can belabor this for 40 minutes, but in the spirit of at the end of the day, I just want to introduce you to stuff. Okay? So one of my recent graduating students, Emily Molahan, worked on a thesis that was focused on the stocker segment. I want to share a couple of things that she found that's very germane for the September market. It's instructive, and it's instructive for you that are working with backgrounding stocker margins in particular. So you've got producers doing that. What she did was looked at the 1993 to 2013 cattle market, and in particular, she's looking at price differentials between calves and yearlings. Because again, that's what that part of the industry is about, right? Price differentials there and the cost of putting those pounds on. What she found was a 1% increase in corn price corresponds with a drop in the price spread. Calves are normally more expensive than yearlings on per hundredweight by 0.37%. However, she doesn't find the same impact of a change in fed cattle price. So 1% increase in fed cattle price 6 months out, because that corresponds roughly with feedlot closeout dates, expands that spread by 1.17. Right? So the key message there, and I'm going to give you numbers for September in a second, is a 1% change in fed cattle has a lot bigger impact, right, 3 to 4 times what a 1% change in corn does on the spread. All right? Give you some context. And we've seen that play out in September. I was lazy. I didn't update these this morning, but it makes the same point. Is if you consider the changes in September from the 1st through the 24th, the December corn contract was up by 3.3%. That corresponds with a little over 1% decline in that calf to yearling spread. Likewise, the February live cattle contract is down, at the time, 5.6%. It would be down even more if I updated them for today. That corresponds with 6.5% shrink. Okay? Both of them are shrinking the calf yearling price spread, is the point. And you see that play out just through the 18th. It'd be even more if I had another week's data in this, by us shrinking that 5-weight versus 7-weight price by $7 per hundredweight. Okay? I'm highlighting this for you because if you're lending to this segment, this is the kind of stuff you need to be monitoring. And some of these corrections that are underway are actually good for backgrounding stocker segments right? Because when you change that price-weight slide, it's favorable for adding weight, right? So things that look like just total bearishness, which they are if you're in the process of selling fed cattle, can actually be bullishness, right, if you're the guy trying to put on intermediate pounds. It's important to think through what role you have, or in this case, the producers you're working with have in this deeper story. Okay? So that works me up to feedlots, which is my least favorite part of the industry to talk about right now, because that's where the bleeding is the deepest. But as I told you in my intro, I'm not going to hide from it. I'm going to tell you what I think and try to explain to you why I think there's so much red ink. This segment continues to have too much capacity. And we're in the midst of holding heifers out of the supply chain, right? So in the short term, that gets even worse because we don't have heifers being placed, okay? And it's a segment that's had red ink for the last few months that held cattle back hoping to get a rally, to be rewarded by waiting, and now is stuck in aggregate with a lot of, let's just call them extra heavy cattle that they're trying to find homes for. So for those of you that don't know this, there's more than anecdotal stories about 1,900-pound animals going to market now. And that only happens because, I mean, over time we increase dress weights. Yes, we have bigger animals, but we also have a fair number of good-sized feed yards that have been holding out hoping for a market rally. And when you do that, animals keep gaining weight. And we've gotten to a critical point where you can't do that forever. So we've got, I don't like the term forced selling, but there's some of that going on, right? You can't hold on forever. And if the packer doesn't want all of them, and by the way, a packer doesn't want a real big animal, it's hard to handle either, you're getting pressure on the market, okay? So that's playing out very hard as we speak. I got the question last week at Stocker Field Day, which is a very germane one, is how long will it take us to work through this? Well, in order to know that, you got to know how many 1,900-pound animals are sitting out there waiting, right, for us to work through. And my best guess is 2 to 4 weeks. I've had some say we might have 2 months of this ahead of us. I think that's probably overstating it, but I don't think we're done yet either from the stories I hear. So it's important to appreciate that it's not just the fed cattle price part of that story, because if you beat up fed cattle price that much, it's going to spill over throughout the entire cattle complex, right? So there's a number of reasons that calf prices are down also, and that's certainly part of the story there. Okay? So the other part of this is a lot of what I just shared with you has happened since I put out this particular piece. Most of you know every month I try to put out a barometer of returns for feedlot segment. I most recently did that on September 10th. And the market's come down a lot since September 10th, so keep that in mind with the red ink I'm getting ready to show you. Okay? When I did this on September 10th, this is my best attempt to estimate returns for a typical feed yard, given average daily gain, in-weight, out-weight, mortality information I get from Animal Science Department, coupled with market information. Okay? So what I have up here is closeouts for different months. They go from August, because there's a 1-month lag in the production data I have, all the way out to May of 16. And every one of these numbers for net returns is negative. When you look at the fourth quarter, that October number is minus 255, November minus 292, December minus 288. So the fourth quarter is minus 275 or so as of September 10th. I have to tell you that if I updated these right now and didn't change anything else, I would add a minus $100 to all three of those because of the market change since the 10th. We've never experienced that before. Okay? So I'm not trying to breed fear. I'm just telling you what things look like. There's over a $20, it's more like $25 spread now, between the projected fed cattle price and the break-even fed cattle price. That's not going to get made up between now and when they close out. Hopefully it'll ease, but it's not going to get made up. Okay? Now, some of this isn't new news, right? For those of you that are older than me, you know there's incredible variability in returns in the feedlot sector. This is a series that goes back to January of 2002. There's really good times, there's really bad times. Things bounce around in this sector. Okay? It's important, and we're being recorded, so I'll admit this in front of the camera as I've been doing elsewhere. I was totally wrong on returns in 2014. I was almost as bearish as I am now. And 2014 proved to be very good for somebody that did not hedge at placement, which is what this exercise mimics. Because if you remember, throughout 2014, yes, there was lots of variations, but fed cattle price went up throughout the year for the most part. So if you didn't hedge at placement, you added weight, let's say your cost of gain were kind of what you expected them to be, you were rewarded, right, for being exposed to higher prices on the outside. That's what happened in 2014. If you do the exact same thing in 2015, you've given it all back because the market's done the opposite, right? You guys know how that works, but this is what this series mimics, is a cash strategy where you don't implement, right, downside price protection, okay? The other thing I'll tell you is, and it's hard to see on this chart, is there's a line right there that's vertical. Everything to the right of this line, roughly where my laser is, those are projections. They have yet to be realized because we project 9 months out. So the bulk of this red is yet to come. We're about a third of the way through that sequence if my projections hold. Okay. The other piece of this I shared, and I shared this at Garden City yesterday because it's obviously germane for those lenders, is not just individual month closeouts, but some sense of cumulative situation. Okay? There's lots of different ways to do that. One simple way I know to do it is simply to give you a rolling 12-month average to give you some sense of the cumulative situation these producers might be in of those that don't have these risk management strategies in place. Obviously some do, but not all do. As of December, which is not that long ago, the 12-month average was 195. It was really good because, remember, you were rewarded throughout 2014 for being exposed to the market. Started the year at 176. By July of this year, we'd wiped that out, and the rolling 12-month average was minus $8. So I put July up as that's the first month it turned negative. If my projections hold, and remember I said some of them need to have another 100 negative on them, as of February, we will have minus 211 for an average over 12 months at that point. That eats to do a lot of equity, right, for anybody that's fully exposed. There's a lot of yards that are price protected, right? So there's a lot of yards that aren't fully experiencing that. But there's very, very few that locked in a positive margin at placement because that's very rare you can do that, right? So you got to keep all that in mind. Anybody that's fully exposed to the market is probably having the worst run they've ever had. That's the reason I'm sharing this. I think you're going to hear more about it, unfortunately. Okay? I like to share these numbers through LMIC. These are quarterly projections. The yellow lines are for the year. So we have 2015, 2016, and then 2017. The arrows tell the real story. We've turned the corner on the tight supply story. Right? We've started the process of expanding the herd. As I said, as long as it keeps raining, I think we're going to keep that up. We're going to start slaughtering more animals. So a 3% increase is projected for 2016, 3.5% increase in 2017. Expected to continue the long-term trend of heavier dressed weights means we're going to start producing more beef. Now, we're starting from a low base because we still don't have a lot of beef being produced by historic standards, but the consumer is going to start to see year-over-year increases in beef production in 2016, 2017 going forward. This is the price slides that mimic that. 15, 16, 17, red arrows on both sides, because regardless if we're talking 5 market fed cattle price or all the way over to calf prices on the right-hand side, we're projecting notable declines. But context is important. So even when you look out to 2016, that calf price projected 233 through 241, which is as of September 28, so it reflects the majority of the September pullback, was still really good by historic standards, but it's not the 285 that some people got in October of 14, right? So yes, it's $50 a hundredweight less, and people wish they had $50 back, I understand, but that is still large enough. We'll keep expanding the herd because the cow-calf segment will still be profitable. Everybody understand that important distinction? Okay. All right. So I want to give you some more context on why the market's doing what it is now and why I'm not as bearish about the demand front as some others. I look at the choice cutout as one of the things to try to understand where the demand concerns are coming from and how strong they are. Because choice cutout prices, that's wholesale beef, that's where we see, right, the supply and demand factors of retailers, grocery store operators, so forth that are buying beef, right, versus packers. That's where that all plays out. Up here at the top, I have choice cutout during 2014. Down here, I have choice cutout during 2015 so far for the year. It's a tale of two different stories. In 2014, we had this green line that, yes, there's all kinds of variations seasonally, but on aggregate, choice cutout kept going up. The cattle prices kept going up. Remember all that. We have a very different tone, right, going on in 2015, and it's not just supply side. We haven't added so many pounds that alone, right, is driving this down. There's growing demand concerns, particularly you can see out here, it really started back in August. The steepness, if you like, of that decline in the choice cutout through August and September is notable. Retailers are pushing back saying they're concerned about consumers buying beef. Right? Time will tell if that's right or not. I don't know what September retail prices are yet because we're not done with September. But that's what's showing up here in the wholesale beef prices.
Is that mostly export or domestic as
Well,
well?
this is a domestic price. But your question about exports, I'm going to get to exports in a second. It definitely reflects the fact that we have export challenges. Right? So there's multiple reasons this is happening. We're not able to export what we could last year. Most people don't think we're going to be able to in 16 either, so that's more bearish. And even domestically, there's some people getting concerned about response to high prices. The latter one I think is overdone, but all of that's showing up on beating up the choice cutout. Okay? The other piece of this that's bearish in tone is some will say we're stacking meat up in the freezer. And we do have more meat in the freezer than we used to, but its context is important. So cold storage is something that's reported every month, just like the cattle and feed report. We have a lot more beef in the freezer now than we did a year ago. And we also have more in the freezer now than we do over the 5-year average. One of the reasons is, to your point, we're exporting a lot less than we did a year ago, so it's staying at home. Okay? The other is, and the kink in this that has some people concerned, is there's some pushback from retailers that are not getting the beef moved. Okay? So that sets a bearish tone. But it's not unique to beef. Pork's going through the same thing. Added up, total red meat's that way. And poultry also has more meat in the freezer, notably than last year, but even compared to the 5-year. So in aggregate, I don't think I have it up here. Yeah. In aggregate, you have both poultry and red meat cold storage numbers that are up a lot compared to about 3 months ago, year over year. So that's a bearish sign that we're having a hard time moving these pounds is the point. And it shows up in places like that choice cutout. Okay. I include these slides here because they give you projected volumes, because I'm mainly giving you cattle points, but I recognize you care about other species, or at least some of you do. These are projections also out to 2017 by quarter. We're going to keep producing more beef in each of the next 4 quarters for 16 as well as 17. We're going to do it for pork as well, so that's buried underneath this red meat chart, as well as poultry. So U.S. consumers are going to see more meat. Right? It begs the question, just how low will prices go if, in fact, we have this many more pounds hit the market? In order to answer that question, I'm going to jump ahead, we have to have some insight about how much of it's going to stay at home versus being exported. So I'm going to go back to your comment yet again, is this chart right here is U.S. beef exports. Goes back to 1991. We had the BSE event. I believe Dustin Pendle probably had a version of this chart up talking about that. We've somewhat recovered, but 2015 is down from 14, and we're projecting 16 to be about the same. That's largely because of global economic concerns and a high U.S. dollar, which Brian's going to talk more about in a minute. Okay? But that is bearish, if you like, for the beef industry. I include this chart. It's the same information, but now it's exports as a percent of what we produce to give you some sense of the reliance on the exports historically for the industry. We've never broke 11% for a year of what we produce being exported. I put the red line there not because I think there's a real ceiling there. I'm just saying we have yet to break it. And if you accept my notion about all this meat that's coming at us because we're expanding, we have to break it. Right? There has to be some success made in exporting more pounds to get some of those pounds out of the U.S. so we don't have as much pushback on the price side. Time will tell if that is realized, but this, kind of invisible ceiling, if you like, 11%, has to be broke. And the reason I'm saying that is if we don't do that, you're going to have even that much more domestic per capita pounds being available, which will push down domestic prices even more, and we'll see that more in live animal prices. Okay? My last slides, I quantify domestic consumer demand using a demand index. I won't bore you with how I do it, but to the point on why I'm not as bearish as others is up until September, the U.S. consumer has been willing to pay more for beef than we ever thought they would. These are my last slides, Rich. 4 years in a row, we've had year-over-year increases in demand. And what do I mean by that? Is yes, we've had less beef being produced and therefore less being consumed, but even accounting for that, the U.S. public has been willing to pay higher price for beef than we thought they would. Now, I have specific numbers for this here, and you can see other versions of that on Ag Manager, but that's a very positive thing that shouldn't be lost in this story. The September developments in the marketplace are fairly new in a concern that have we turned that story. Time will tell because I got to see the September prices to know that or not, but that's the potential turning point on the demand front that we're at. I'm not as convinced that it's as bad as some of the market participants because through August, I included this just to remind me to show you, I don't have September prices, but I do have July and August, right? So I'm 2/3 of the way there to speaking for the third quarter. We still had an 8% increase in the price being paid for the first 2 months of that quarter. September may well be down, right? But we at least started the third quarter with a willingness to pay higher prices than the year before. Now, that doesn't mean demand was as strong as it was third quarter of 14. Don't go that far on me. But that's a positive signal that the consumer hadn't stepped away yet from paying those higher prices. Okay? I'm going to really watch for that September price, the retail level, to figure out exactly what did the consumer do in September. Are those beating up of the choice cutout values, justified and so on and so forth, to figure out if the market's kind of overdone this correction we're in the midst of. But obviously we won't know that until it's about the second week of October before we get the September beef retail prices from USDA. Okay? This is my last slide. Hopefully you follow my point. We've turned the corner on supplies. We're expanding the herd. As long as it rains, we're going to expand the herd. That means more beef, right? The second point, demand is always important. It was hidden in the story in the past. We had tight supply and strong demand, so you had high prices. Well, now we have less tight supply with mixed signals on demand. You're seeing that play out in a bearish sense right in September. But more generally going forward, the role of demand is going to be more clear to everybody because as you remove the tight supply story, it becomes more obvious that you need strong demand to keep prices up, or stated differently, to keep them from going down as fast as they will otherwise. All right? Those are both true. They hinge upon strength of demand. I put out a piece with Ted Schroeder. There's a link there where we belabor that point. But particularly as the herd goes into expansion phase, it's going to be very important that the entire industry understands what demand is and breaks things like that 11% threshold in exports and so forth. Okay? I purposely skipped in the middle because I was going long early. I'll take any questions you have. I'm sure Brian will give me at least 3 more minutes.